Hello and welcome. Today we are tackling a huge question that, let's be honest, probably keeps a lot of people up at night, especially when retirement is on the horizon. And that is, how on earth do you protect the money you've spent decades saving, but also make sure it's still growing enough to last you? It's a real balancing act. So let's dive into one potential solution. If you're getting close to retirement, or maybe you're already there, you're probably feeling this constant push and pull. You've worked your whole life to build up your savings, and the idea of a sudden market crash just wiping out a big chunk of that, it's absolutely terrifying. But you also know that your money can't just sit there. It has to keep working for you. It needs to grow if you want it to last for the long haul. And that really brings us to the heart of the matter, doesn't it? It's the classic retirement dilemma. How do you get some of that sweet market growth without leaving yourself completely vulnerable to the scary downturns? Is it even possible to get the best of both worlds? Well, as it turns out, there is a whole class of financial products out there that were literally designed to solve this exact problem. They're known as annuities with cash value, and their entire goal is to find that perfect sweet spot right in the middle between the safety of, say, a savings account and the growth potential of the stock market. So what is an annuity with cash value when you boil it all down? Think of it like a contract, a deal you make with an insurance company. You give them a lump sum of money, and in exchange, they promise to give you a steady income stream down the road. But the cash value part, that is the magic ingredient here. That's the portion of your money that has the potential to actually grow over time. Now, these products are really built around a few key promises. First, the growth is tax deferred. What that means for you is you're not paying taxes on the earnings every single year, which really lets your money compound faster. Then there's the promise of a guaranteed income stream for life, some level of access to your cash before you turn on that income stream, and even a death benefit for your family. It's a whole package of features really designed for security and peace of mind. But here's the thing, annuity is a really broad term. It's kind of like saying ice cream. So it helps to think of them as coming in three main flavors. Each one offers a totally different mix of risk and potential reward. All right, first up, we have the most straightforward, no-frills option, the fixed annuity. This is like the vanilla of the annuity world. It's simple, it's reliable, and best of all, it's predictable. You know exactly what you're going to get. So the trade-off here is pretty clear, right? On the plus side, you get predictability and simplicity. You know your interest rate, and that's that. The downside, though, is that your growth potential is pretty limited. And the really big question you have to ask yourself is whether that guaranteed but kind of low rate of return is actually going to be enough to keep up with inflation over the years. Okay, our next flavor, the fixed index annuity, tries to add a little more excitement to the mix. This one is really designed for the person who says, I want the chance for better returns, but I am still terrified of losing my hard-earned money in a market crash. Now, here's where it gets kind of clever. Your returns are linked to a stock market index, something like the S&P 500. So when the market does well, you get to participate in some of those gains. But, and this is the big but, if the market tanks, your principal is protected. You don't lose money. So what's the catch? Well, your upside is usually limited by things called caps or participation rates, basically a ceiling on how much you can earn. That's how the insurance company can afford to give you that downside protection. And that brings us to our final and definitely most aggressive flavor, the variable annuity. This is for the investor who wants to stay in the game, who wants that high growth potential of the market, but wants to do it inside the structure of an annuity. With a variable annuity, your money is directly invested in things called subaccounts, which are a lot like mutual funds. Now, this gives you the highest ceiling for growth, no doubt about it. But it also comes with the most risk. You are completely exposed to the market's ups and downs. That means if your investments do poorly, your account value will go down. It's the true high-risk, high-reward option of the three. Okay, so we've looked at our three different flavors. Now let's put them all together, side by side, so you can really see which one might line up with your own financial personality and what you're trying to achieve in retirement. Seeing them all laid out like this really makes the relationship crystal clear. As you move from left to right, from a fixed to a variable annuity, you're essentially just turning up a dial. You're turning up the potential for growth, but you're also turning up the potential for risk at the same time. It really becomes a spectrum, all the way from the super conservative saver who wants safety above all else to the aggressive investor who's willing to take on that risk for a shot at higher returns, with the fixed index option sitting right there in the middle. So what's the bottom line here? When we zoom out and look at the big picture, who are these products really for? Let's try to figure out if this is even a path that's worth exploring for you. So, who's the ideal candidate? Well, generally, these products tend to appeal to people who are at or very near retirement, people who really value some kind of guarantee, whether that's protecting their principal from losses or just ensuring they have a predictable paycheck for life. On the flip side, they're probably not a great fit if you're, say, a younger, do-it-yourself kind of investor with decades to go, or if you need to be able to access all of your money at a moment's notice. And that really leaves us with this one final, and I think most important question to think about. At the end of the day, the choice really comes down to what you value most. What lets you sleep at night? Is it the rock-solid security of a guarantee, just knowing that you can't lose your principal? Or is it the potential for higher returns, even if that means accepting the risk of loss? Answering that for yourself, that's really the first step to building a retirement plan that's truly right for you.